Most people think the stock market is simple. You buy shares, you hold them, and later you sell them. But modern markets allow something very strange. Sometimes investors sell their shares and still keep exposure to them. It sounds impossible, but companies in Pakistan like TPL and Waves have actually done something very similar. Let's understand how. Imagine you own a house worth 10 million rupees, but you suddenly need cash for business. So you sell the house and receive 10 million rupees. Normally that means you no longer benefit if the house price rises. But imagine you make another agreement. You sign a contract saying, in 6 months I will buy this house back for the price agreed today. This agreement is similar to a futures contract. It allows you to sell something today but still have a future claim on it. A futures market is simply a place where people trade agreements about the future. Instead of buying the asset today, they agree on a price today for something that will happen later. For example, today a stock is 100 rupees. Someone might sign a contract saying, I will buy this share next month for 105 rupees. If the price later becomes 120, the buyer benefits. If the price drops, the seller benefits. The important thing is this: you are trading the contract, not the asset itself. Another important thing about futures is that you don't need the full money. So with a small amount of money, you can control a much larger investment. Also, these contracts expire every month. But before expiry, investors can simply close the current contract and open the next one. This is called rolling over the position. And this is the key trick. Companies like TPL Corporation and Waves Corporation owned large amounts of shares in their companies. They wanted cash, but they also wanted to keep exposure to the shares. So they did something clever. First, they sold their shares in the regular stock market and received cash. Then they went to the futures market and bought futures contracts for the same shares. Because futures require only a small margin, they didn't need to invest the full amount again. Then every month they simply rolled the contract forward. So economically they still benefited if the share price went up. In simple words, they sold the shares but still stayed connected to the share price. This strategy gives companies two things at the same time. First, they get cash today by selling the shares. Second, they still benefit if the share price rises in the future. It's like unlocking money from an asset without completely losing its upside. A graphic showing a stock market crash. If the share price falls sharply, companies must deposit additional cash. If they cannot do that, the position can collapse. Modern financial markets are no longer just about buying and selling assets. They are about managing risk and exposure, and tools like futures allow investors to do things that once seemed impossible. Disclaimer: this video is for educational purposes only and is not a buy or sell call.